people, we're all doing good. So in today's session, we'll be looking at a specific question relating to IND AS 110 consolidation. So in RTP November 2023, they have given a good question relating to consolidation chapter. So that we will be going through in the today's session. Okay, so that's going to be the scope. Right. So without further delay, let's get started. So Ishwar Limited holds investment in Vinayak Limited. The draft balance sheet of two companies on 31st March 20x4 is being given. So all the numbers are in thousands. Okay, so pretty much usual. 1 second. Yeah, moving along. So all the equity shares ka face value or nominal value is 1 rupees. Retained earnings, and we also have other components of equity. Other than retained earning, we have another reserve that they're calling it as other components of equity. So keep this in mind. Then the usual thing, it's okay. Now, the balance sheet date, so keep this in mind. They have given the balance sheet as on individual SFS of the two companies' balance sheet. They have given as on 31st March 20x4. Now they are saying Ishwar Limited investment in Vinayak. So Ishwar has made an investment in Vinayak. So looks like Ishwar is your parent, Vinayak Limited is your subsidiary company probably. On 1st April 20x1, Ishwar acquired 400 million shares in Vinayak. Sir, so here if you just check all the numbers they have given in thousands. Here they have given it in millions. So you have to express in one number. Since all these data are in thousands, this data also I'll take it in thousands itself. So 400 million if you have to express in thousands, no, just add 3 zeros, that's all. Okay. If you have to express this 400 million in thousands, so it simply becomes 400 and add off 3 zeros. That will become your numbers. All this will be in sync now. Okay. So what is the share capital of this? Is I think the first company is Ishwar and then it is the Vinayak. Vinayak share capital is 5 lakh. Okay. 5 lakh and each share ka face value is 1 rupee. So we totally have 5 lakh shares. All these numbers are in thousands. So out of 5 lakh, 4 lakh shares the Ishwar has acquired. So 4 divided by 5 into 100, the shareholding percentage is 80%. So non-controlling interest has about 20%. But mind you, the date of control is 1st April 20x1. And they have given the balance sheet as on 31st March 20x4, meaning 3 years later. From 1st April 20x1 to 31st March 20x2, 1 year, 31st March 20x3, 31st March 20x4. So third year ka we need to prepare CFS because we know CFS is a regular activity, right? As long as you have control, you have to go on preparing CFS. So third year ka CFS is what probably the requirement of this question is. Alright, so we have acquired 400 million shares in Vinayak by the means of share exchange. So PC is discharged in the form of shares. 1 share for every 2 shares acquired. So for 2, we'll give 1, right? So for 400, how much it will be? For 400, 200 million shares we will give. So this also, if you want, you can express in thousands only and multiply by what, sir? For PC, we need value of shares. We don't need the number of shares. And the market value. Who has issued the shares here? The parent company. Parent is Ishwar. Ishwar Limited ka market value of the shares on the date of control have they given? Yes. On 1st April 20x1, the market value of 1 share of the parent company Ishwar is 7 rupees. 200 million shares totally they'll give. Each ka value is 7 means 1400 million shares will be given as PC. We have to want to express this in thousands. So just add 3 zeros. 1400 into 3 zeros if you add, you'll get about 14 lakh. Yes. So 14 lakh shares have been rolled out by 14 lakh worth of shares. Value of shares is being given by the parent to the subsidiary in relating to subsidiary acquisition. Great. Ishwar Limited appointed professional firms for conducting due diligence for the acquisition of Vinayak, the cost of which is 15 million. So all these are transaction cost. IND AS 103 says at the time of business acquisition, any transaction cost will be transferred off to SPL. So this will go off to SPL. Ishwar Limited included acquisition cost in the carrying amount of investment. So they added this in the carrying amount of investment. Maybe all these are acquisition costs, so they've added because obviously, I mean, investments are valued is a financial instrument, right? So they've considered this. That's okay. That's for the valuation. But as far as business combination is concerned and consolidation is concerned, these are all transaction costs. They should not be considered. So basically investment value, this 15 million has been added to the cost of investment. So due to this what, sir? All these are transaction costs. It should be transferred off to SPL. Instead of transferring it to SPL, they've added to the cost of investment. So what do we need to do? Investment in subsidiary ka balance, we have to reduce by 15 million or 15,000 if you have to express in 1,000. And what, sir? This amount you have to transfer it to what? The retained earnings, right? Because parent has purchased this. So parent company ka retained earnings has to reduce because this expenditure has to be transferred to parent ka SPL or retained earnings. So parent ka retained earnings due to this adjustment will reduce by 15,000. So this we need to keep in mind. Alright, sir? Because we do prepare other equity curve working note at the end, you know, right? So there we have to reduce this by 15,000. This is one adjustment. Keep this in mind. So there is a tendency to forget because in this question they have given a lot of adjustment. So as and when you find, I've just given a highlight so that at the end of it, we'll remember to capture all this. Okay, on 1st April 20x1, meaning on the date of control, in fact, they've said something here, there has been no change in carrying amount of investment, blah, 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 and also told that para is done. On 1st April 20x1, meaning on the date of control, individual financial statements of Vinayak showed the following balance. So, 1st April 20x1 is your date of control. On the date of control, they have given subsidiary retained earnings and other components of equity. So, all these are already existing. So, these are pre. This 750 million and 25 million is the pre-acquisition profit because these are already existing. Now, check. Vinayak Limited ka retained earnings ka closing balance is what? On the date of control, it was 750 million. 750 million if you have to express in full value, it will be 7,50,000. After 3 years, it has become 10,50,000. From 7,50,000 on the date of control, after 3 years, it has become 10,50,000. So that means the post-acquisition profit will be 10.5 minus 7.5, which will be 3 lakh will be your post-acquisition retained earnings. Correct? Because we have to know all the reserves and surplus of the subsidiary company, other equity of the subsidiary company. You have to allocate between pre and post and accordingly do the calculations. Similarly, other components of equity is 25 million on the date of control. 25 million as in 25,000. So this 25,000 is pre-acquisition. So this is 3 years before. 3 years later in the current financial year, for the current financial year ended, other components of equity ka closing balance has become 50,000. It was 25,000 on the date of control. Now it has become 50,000. So it has increased by 25,000. So that is your post-acquisition other components of equity. Okay, that we have given. Great. Next, they have given directors of Ishwar Limited carried out some fair value exercise. We know IND AS 103 says that subsidiary all the net assets have to be taken at fair value on the date of control. So they have done a fair value exercise and they have called out a few things. Property, one asset, carrying amount is 800 million. This particular property has a land component and building component. Total is 800. In this 800, 350 million relates to the carrying amount of land and 450 is a carrying amount of building. That is a carrying amount that they've given, but we need fair value. It had an estimated fair value of 1,000 million. Carrying amount is 800, but fair value is 1,000. So we do this as fair value adjustments. Remember, when working on normally, before we start consolidation question or pointers. In fact, the way we used to prepare consolidation working note is what's up. First, we prepare net assets on the date of control. Okay, once you know that, then we calculate goodwill. Okay, then we analyze, we prepare a working note called analysis of post-acquisition reserves and surplus of subsidiary company. Then we prepare NCI. Then we prepare after NCI, we prepare what basically, excuse me, the other equity working note. Yes, these are the usual working notes we see in consolidation problem. But other than this, if you have any fair value adjustments, we will prepare some extra working note for that. If you have any unrealized profit made by parent to subsidiary or sale made by subsidiary to parent, whether it is downstream or upstream, we prepare one extra working note for that. Correct? So here there is a fair value adjustments. Okay, so I've also prepared a shareholding percentage as a working note. If you want, you can do it, or otherwise it's okay. We already got to know it is 80-20, right? Because out of 500 million, 400 million is acquired by parent, so 80%. All right. Now they have given adjustment relating to fair value adjustment. Hence, we'll prepare one working note for fair value adjustments on the date of control. All the numbers are in thousands. Okay, so what are they saying now? Let's go back and read the data and capture it off. So land ka carrying amount is 350, but land ka fair value has become 400. We'll go land separately, building separately. Why, sir? Can we do it together? No, sir. Due to this fair value adjustments, you will get additional depreciation, right? Right? Because if for consolidation purpose, if you are taking fair value, but subsidiary has taken carrying amount. So that means that since we are considering for consolidation purpose fair value, depreciation has to be calculated on fair value for a CFS perspective. But subsidiary company would have calculated depreciation on their assets at carrying amount. So you will get some additional depreciation. If there is fair value increase, due to that asset value increasing, you will get some extra depreciation, which we used to refer it as additional depreciation. If fair value reduction is there due to this exercise, then subsidiary has charged higher depreciation, which we need to reverse. All this we have done in many questions in consolidation. Yes. Since on land, we don't have any depreciation, so we'll segregate. Land carrying amount is 350, fair value is 400. So the fair value increase with respect to land is 50 million. We'll take off. Okay. Similarly, building carrying amount is 450, fair value is 600. So the fair value increases 150 million or 1,50,000 if you have to express in full value. Correct now? So that is one. Then, all right, next. The building they're saying estimated useful life is 30 years. On the date of control, that is 1st April 20x1, building is expected to have a 30 more years remaining useful life. Since due to this fair value adjustment, building value is increased by 1,50,000. So you will get, since the asset value is increasing due to consolidation adjustment, and you will get additional depreciation relating to building. How much is that? How much did the building value increase? 1,50,000. I've calculated this in million and it's okay. You can write 1,50,000 here. It's okay. All right. Minus what? Residual value not given. Divided by what? 30 years is a life. Just don't leave it at that. Sir, they have done all this exercise on 1st April 20x1. Currently, our year is ending on 31st March 20x4. We are preparing CFS for 31st March 20x4. If you want to look at the requirement over here, once again, I'll show you. Prepare consolidated balance sheet on 31st March 20x4. That means what, sir? From 1st April 20x1 to 31st March 20x4, if you count, that's about how many years? 3 years. That means we need to calculate additional depreciation for 3 years. If you do this, you'll get depreciation for 1 year. So multiplied by 3 you'll get the total depreciation for 3 years, total additional depreciation for 3 years, which is 15,000. Okay, sir. So this is captured. Done. Land, there is no depreciation, so we are sorted. Next, what else is given? Some plant and equipment, they're saying carrying amount to 600, fair value 700. So that means on plant and machinery also we have some fair value increase of how much? 600 has become 700. So the increase is 100,000 or 1 lakh. Yes, sir. So since the value is increasing, plant is a depreciable asset, additional depreciation will come. Yes. How much did it increase by? 100. This is in millions. So if you want, you can write it in 1 lakh itself. That's okay. So this is 1 lakh minus 0 because the residual value not given. Have they given the life of this plant and machinery? Yeah. The remaining life of this plant was on 1st April 20x1 was 4 years. Again, now we are on 31st March 20x4. So we'll have to calculate additional depreciation for 3 years. So divided by 4, which is your life, into 3 years, because that's the total life we are talking about. I mean, the consolidation date, 3 years have passed, hence multiplied by 3. So you'll get additional depreciation to be 75,000. Okay, sir. All right. So this are captured. Maybe we'll take off this. So these two we are done. Okay. So fair value adjustments these 2 points we have done. Next, on 1st April 20x1, they've done a lot of fair value exercise. So this and this is done. The notes to financial statements of Vinayak subsidiary company disclose contingent liability. So subsidiary company has some contingent liability, and we have studied IND AS 37. As per IND AS 37, contingent liabilities are not accounted, but they are only disclosed in notes documents. Yes, no, sir. But we have studied IND AS 30 also, IND AS 103 also, business combination. There are some recognition exceptions, right? Even if subsidiary company is disclosing contingent liability, but for business combination perspective, such contingent liability will have a fair value and you still need to record it. Okay. But in separate financial statements, contingent liability is not recorded because you apply IND AS 37 ka provision. But here we are doing consolidation, meaning on the date of control, we have to apply business combination ka standard, IND AS 103. And the end of the year, we have to apply IND AS 110, right? So all this exercise is done on the date of control. So IND AS 103 says even such contingent liability needs to be recorded, but subsidiary has not recorded. So one extra asset you need to record. How much is that? The fair value of contingent liability is 30 million. So this one extra liability we need to record. So when you record one liability, net asset balance will reduce on the date of control by 30 million. If you have to express in thousands, it will be 30,000. Okay. Yeah, the contingent liability was resolved in the year ended 31st March 20x2. So on the date of control, 1st April 20x1, it came. Okay. Immediately at the end of the year, it has got resolved. That means whatever contingent liability you booked, you need to reverse it. So this is a subsidiary related one, no? Okay. So on the net assets, when you calculate net assets on the date of control, you should consider this particular contingent liability. Okay. And immediately later reverse it. Right. So reversal, what will happen post acquisition? This is relating to subsidiary company. So post acquisition profit of subsidiary company, because reversal is not happening not on the date of control. Reversal of contingent liability is happening after the date of control. Hence it affects post acquisition profit of subsidiary, because this is a component related to subsidiary and not parent. So don't write retained earnings. Okay. This is the component relating to subsidiary. Hence post acquisition profit of subsidiary company will increase, because why? You have to reverse one contingent liability, no? So right. So that means what, sir? You have to pass a journal entry. So we can write here, we'll not write contingent liability, we'll make a provision. Okay. Provision for contingent liability or something, you can write debit. We need to cancel it. No, by how much? 30,000. To what? You have to credit something. So you will credit the retained earnings of the subsidiary company, not of the parent. Okay. This exercise is done after the acquisition. So this will affect the post acquisition profit or post acquisition retained earnings of the subsidiary company. That's what I've written over here. Okay, sir. All this exercise we'll see. Let this be there. Then I'm doing the working note. Again, we'll cross check. Alright, the fair value adjustments have not been reflected in individual financial estimates. That we know, because fair value adjustment is IND AS 103 ka and business combination ka and consolidation requirement, right? So this is not the requirement in individual financial statement. So subsidiary has not done this. It's okay. Alright, the fair value adjustments will be regarded as temporary difference for the purpose of computing deferred tax. So we already know if any asset ka balance increases or decreases, there will be DTA, DTL impact. Yes, we know this. For asset, if carrying amount is greater than tax base. If carrying amount is greater than tax base, we create deferred tax liability. Yes, no, sir. Similarly, for liability, if carrying amount is greater than tax base, we create deferred tax asset. We studied all this, correct? Now, why am I writing these two specific equations? Sir, for three assets, land, building, and machinery, carrying amount. We did not take carrying amount for consolidation purpose. We took fair value. So that means what, sir? The fair value itself becomes revised carrying amount. But all this fair value exercise is only IND AS requirement. It is not there in Income Tax Act. Income Tax Act may tax base will not increase because there is no fair value adjustment drama in income tax. It's only accounting drama, that too IND AS 110 or IND AS 103 ka accounting drama all these are. So due to this particular fair value adjustment, carrying amount will increase, but tax base will remain the same. So hence, on all the assets, land or building or plant and machinery, all their assets value increased. So that will lead to creation of DTL. But there is one liability also, contingent liability, subsidiary company did not record. So tax base was 0 because it was a contingent in nature. But you, by applying IND AS 103 ka provision for consolidation purpose, you need to consider that. So you did record one carrying amount of liability. Okay, you have recorded carrying amount of contingent liability to be 30 million, but tax base is 0. Right? So that means carrying amount of tax base for a liability is greater than tax base. So you have to create deferred tax asset. So this particular contingent liability wala adjustment is giving rise to DTA, and 3 assets ka fair value increase is giving rise to DTL. So we know this, we have studied, right? We will not record both DTL and DTA. We'll net off, and whichever is higher, that particular component we will record. So that exercise we will see in a bit. Okay, Saru. I'm just quickly running through the problem with you. Okay. So the directors of Ishwar Limited use the proportion of net asset method when measuring a non-controlling interest. So they are saying net asset is valued on a PSNA, proportionate share of net asset basis. Great. So this one all is impairment. We'll talk about this later. So these two are good adjustments. So we'll talk about this later. But till now, whatever we need up to the date of control, I think more or less all the adjustments we have got it. So let's run through with our regular working notes. So fair value adjustments, all the things we did. Yes, no, sir. Okay, so total fair value adjustments on the date of control, we got it to be 3 lakh. So what about contingent liability? I'll record that separately. If you want, you can bring this in that working note only. Absolutely no issues. Okay, here only you can write contingent liability is increasing. So all these are asset ka value increase. Contingent liability ka value increase, you can show it as reduction. That is also fine. Okay, I'm showing that separately. That's okay. The presentation part is your call. So additional depreciation also we have done. Shareholding percentage we have done. So that's okay. Now net assets on the date of control. So how do you get net assets on the date of control? We take the equity and other equity of subsidiary company on the date of control, right? And then if they have any fair value adjustments and any contingent liability not recorded and all, we need to consider. Now, what is the share capital of Vinayak? Share capital is 5 lakh. So this is the share capital on 31st March 20x4. Since they have not given the data, the normal assumption is on the date of control also, subsidiary company had the same share capital. So share capital is 5 lakh, that we can take off. Yes. 1 second loading. Yeah, this is done. Next, what is that? The other equity portion. Have they given the breakup? Yes, they have given in that table. Check. The date of control retained earnings was 750. They have given all this data. This is 7,50,000. We wrote here also. So this much is already existing. Other components of equity are it's already existing 25,000. So 7,50,000 and 25,000. So tick off that also. Okay, so there is already existing on the date of control. Then do we have any fair value adjustments? Yes. On the 3 assets we have fair value adjustment to the extent of 3 lakh. Add up that. Then one liability we need to record. When you record one liability, obviously net asset balance will reduce. What liabilities are? Contingent liability. That was 30 million we wrote over here, no? Yes, 30 million, correct? Where is that? Here, 30 million. 30 million is nothing but 30,000. On liability, if you have to record, net asset balance on the date of control will reduce. So this is the thing. Now, we already decoded this. So on this one, we need to create, on these fair value adjustment, asset ka carrying amount is increasing. So you have to create deferred tax liability. But here liability ka carrying amount is increasing than the tax base. So we have to create DTA. The asset may gives rise to DTL, and liability ka carrying amount increase will create to DTA ka creation. Now check which is higher. This is 3 lakh, this is 30,000. So looks like deferred tax liability portion only is higher. Net off. So 3 lakh minus 30,000 you do, which is how much? 2,70,000. Have they given the tax rate? That is the difference. Taxable timing difference, right? Net is 2,70,000. Have they given the tax rate? Yes, tax rate is given to be 20%. So multiply, sir. 3 lakh minus, in fact here, 3 lakh minus 30,000 if you do, you will get 2,70,000. 2,70,000 got 20%. 27 2s are 54. So deferred tax liability, net amount, okay, net deferred tax liability is 54,000. We don't record DTL and DTA separately. We'll net off and show the whatever is the highest amount. Here deferred tax liability is higher, so we'll record deferred tax liability. So since you have to record one liability, due to liability, net asset balance will reduce. Hence, DTL is shown as negative figure. So adding all this, you will get net assets on the date of control, which is 14,91,000. That is one point. Okay, Saru, this is one. Next, once you know net assets, we can find out what's the goodwill, right? So first, PC. Do you know PC? Yes. 400 million was the total shares acquired by the parent and subsidiary that they had told. And this was acquired through share exchange. For 2 shares, we gave 1 share. So yes, no, for 400 shares, how many shares we will give? 200 million. We wrote this already over here, no? Here only, just check it. Yeah. 400 into 1 by 2. And the value of each share is 7 rupees. So this 1400 million is given as PC or 14 lakh. I've just shown that calculation here. Instead of separate working note, I've shown it here only. Okay. So this is in million. If you want, you can convert this into 1000 itself. Okay. So instead of 400, add 3 zeros. So 400 into 3000 will be, can I add 4 lakh? So 4 lakh into 1 by 2, which is 2 lakh. 2 lakh into 7 will be a 14 lakh. That's given as PC. Right? Okay. Then we have any NCI? Yes. This is only for 80% stake. No, that means NCI holds about 20%. And NCI, are we using fair value method? No, they told in the question we're using PSNA basis. So do you know PSNA as in proportionate share of net assets? So do you know net assets on the date of control? Yes, 14,91,000. That ka 20% is the NCI ka share, which will be 2,98,200 or 298,200. Yes. Then what's the reduce net assets on the date of control, which is 14,91,000 already we got. So doing this, we'll get goodwill on the date of control, which is 2,07,200. They have given some adjustments about impairment of goodwill, which we will talk about it later. Till here we have covered. Okay. And this goodwill is partial goodwill because NCI is valued under PSNA basis. Right. So if there is any impairment loss that you're getting subsequently on this goodwill, this impairment loss will only be taken up by the parent because this is parent share of goodwill only is what we have shown. Keep that in mind. This portion we'll talk about it a little later. For the time being, ignore that. Yes, sir. All right. Next, after this is done, we'll do analysis of post-acquisition profit of subsidiary company. That also we already wrote it over here. How much was that post-acquisition profit, sir? We gave a breakup also somewhere. Where was that? Here. Post-acquisition retained earnings is 3 lakh. Post-acquisition other components of equity is 25,000. So first we'll start with retained earnings. Post-acquisition retained earnings is once again 3 lakh. Correct? All right. Then any consolidation adjustment is there? Yes. Since we did a fair value adjustment, you will get some additional depreciation. Depreciation you charge at the end of the year after you get the control. So depreciation will come under post-acquisition profit side of adjustment. So what is the additional depreciation on building and plant machinery? 15,000 and 75,000. Due to depreciation, all these are consolidation adjustment. Subsidiary company has not done this. Without doing this adjustment, subsidiary ka post-acquisition profit is 3 lakh. Okay. They have not considered few expenses which we need to consider for consolidation purpose. So additional depreciation, how much is that? 15,000 and 75,000. So due to additional depreciation being an expense, due to this expense, profit will reduce. So 15 and 75 you need to reduce. Okay, all this we have again done. These are all repetitive question to us. 3-4 questions we have done in our regular class and fast track class for this. Yes. Okay, this is one. Okay, and one more thing is, you remember we record on the date of control, we recorded a contingent liability of 30 million. Was that liability there? No, we reversed it, right? We also wrote the entry also here for that. Okay, we record contingent liability and we reverse it, right? Reversal entry is provision for contingent liability to retained earnings of subsidiary company. So due to this, what will happen? If you reverse one provision, retained earnings balance will of subsidiary company will increase. So this was done after the date of control, so it should come under post. So check have they added 30,000 where here where is that working? Here provision for contingent liability reverse 30,000 plus. Okay, so this is normal. Okay, this in fact you can keep this as a box. You should not forget to do this. So whatever I'm boxing over here, no, in a way you could keep that as a checkpoint to make sure that this is something, because all these are some things which we have not seen in our regular class questions. These are, you could say, the overall setup of the problem is pretty much the same. About 4 to 5 adjustments have been newly added in this particular question. So that makes the question, this particular question, a little more interesting. So the things which are boxed are something which you need to revise a little further or practice one more time, or to make sure that you don't commit mistakes in these boxed items. That is one. Next important item is, sir, now when fair value increased for the assets, you created deferred tax liability here. You have done it. Yes, no, sir. Correct. On the date of control, fair value was greater than the carrying amount. So you recorded that fair value adjustment and you recorded DTL also, because since there was fair value increase, carrying amount increased, carrying amount was greater than tax base, hence you recorded deferred tax liability. And we know that this deferred tax liability, deferred tax assets and all, they're not permanent assets. They are only bookish assets. They are timing assets. Okay. For the time being, they'll be there. Eventually, it will get reversed out. Correct? No. Right? Now, when you just recorded fair value adjustments on those assets, no, sir. You also charge additional depreciation. No? That means what, sir? You charged, now building a value, you increased by 1,50,000. Since building value increased by 1,50,000, so on this you created a deferred tax liability because carrying amount is greater than tax base by 150. Correct? We didn't calculate individually, we calculated total basis, but just calling it out individually for once again for reference. Correct? Now, after the date of control, you charge additional depreciation, right? Extra depreciation you charge. And when you charge the depreciation, what will happen to carrying amount? Carrying amount will reduce. Tax base will be same. Correct? No. So due to fair value adjustment, carrying amount increased. So you create a deferred tax liability. Now due to additional depreciation, carrying amount is reducing. So you will create what? DTA. No, you already have deferred tax liability. When you already have deferred tax liability, now you will not create DTA. What you will do? Whatever deferred tax liability you have created, you have to reverse. So deferred tax liability you need to reverse. That is one good adjustment in this. Okay. So that is which we had not there in our regular normal class question. That has newly come in this particular problem. That way, this is a good question in my view. So how much due to additional depreciation, how much carrying amount is reducing? 15,000. Only one asset. No, even plant and machinery you are getting additional depreciation. So how much? 75,000. So when you charge this additional depreciation on plant and machinery, carrying amount of plant and machinery once again will reduce. When carrying amount increased, you create a deferred tax liability. When carrying amount reduced, we need to create deferred tax asset. No, you already created liability. No, science what you do. So since you already created deferred tax liability, now you have to reverse. So on these two components, how much is that? 15 plus 75 is 90,000. On 90,000, that is the difference. Take the difference, multiply by the tax rate. On that, you need to reverse deferred tax liability. That's all, sir. No. One more thing was there, which is what? So you created deferred tax liability only on these two. No. You considered fair value adjustment on all the three assets. And what? So what about land? Land, you will not get additional depreciation. No? So nothing is happening. Forget land. So this adjustment is related to only building, plant and machinery and the provision for contingent liability. When liability value increased, right? What did you do? All right. You created deferred tax asset. Instead of deferred tax asset, you reduce deferred tax liability. Yes or no? Correct. So now is this liability there? No, on the date of control, this liability was there. At that year ended. That year ended itself. The day you got control, all right, that year ended itself, contingent liability you reversed. That means what? On these two components, you have to reverse deferred tax liability, which is how much? 90,000. Correct? 75 plus 15,000. This is 75 and this is your 15, right? So 90,000. On these two, you need to reverse deferred tax liability. But on this, on provision for contingent liability getting reversed, what do you need to do? Sir, when you reverse a contingent liability, when you reverse a provision, what will happen, sir? You have already had a liability that you are reversing. So carrying amount of liability will reduce, right? That means what? If carrying amount of liability is 1 lakh, okay, maybe we'll tell it one way only. Okay, if carrying amount of liability is reducing, means carrying amount of liability will be lesser than tax paid. So you need to create what for this? For this particular component, we need to create deferred tax liability. Additional liability we need to create on this. Correct? Ulta of that. For these two, if it is deferred tax liability ka reversal, on contingent liability, it will be deferred tax liability ka creation. These two, if it is reversal, means that one will be creation. So we don't do DTL ka creation, DTA ka reversal and all separately. We'll net off because initially also we created like that only. No? Here we took, this is the fair value increase on all assets. This is liability ka reduction we did. Now due to additional depreciation, same. Okay, so do the same equation. Rest, how much is that? Due to 90,000, deferred tax liability will get reversed. And due to provision for liability ka reversal, additional deferred tax liability will come. So set off these two. So 90 minus 30 is how much? 60,000. So this is the difference. Right? We take the difference and multiply it by the tax rate. Tax rate is still how much? 20%. So 60,000 ka 12% will be, or 20% will be 12,000 rupees. So this is your deferred tax liability ka reverse, not creation. You already created. Now we need to reverse it. Yes, sir, people. Okay, that we need to add up. Sir, why do we need to add? Sir, DTL you are reversing. When you are reversing a liability, what journal entry you will pass? You will write deferred tax liability has credit balance. Now you are not creating, you are reversing. So deferred tax liability will be debited, and this is deferred tax liability relating to subsidiary assets and liability. Okay, so you can't write parent, you can't credit parent ka retained earnings. So since this particular deferred tax liability is relating to subsidiary company, you will credit what? Subsidiary company ka retained earnings. And all this adjustment is not done not on the date of control, but after the date of control. So it will not affect pre-acquisition profit, but it will only affect post-acquisition profit. So since subsidiary ka retained earnings already has credit balance, again if you're crediting, its balance will increase. Hence I've written plus here, plus 12,000 rupees. Done, sir. So these are the two adjustments which we need to be little careful in this particular question. Okay, DTL ka creation we have done. All right, we have done such question. That is not a new thing to us. All right, but the reversal due to additional depreciation and the liability also getting reversed. You should not forget that. Okay, so net off, since we are creating deferred tax liability on a net basis, asset minus liability, and here also reversal also you do it on net basis. Okay. All right, if you are not comfortable on net basis, you can write DTA reversal on assets 90,000 ka 20%, which is 18,000. 90,000 ka, excuse me, 20% will be 18,000. Then on this 30,000, you have to create additional deferred tax liability. Like that also you can write 30,000 into 20 will be 6%. So 18,000 you can plus, 6,000 you can minus. How 18,000? So 75,000 plus 15,000 will be 90. So 90,000 into 20%. This is what, sir? Carrying amount is reducing. So you need to reverse deferred tax liability. You need to reverse to the extent of 18,000. This is relating to assets. On liability ka carrying amount is getting reduced. Okay, so liability ka carrying amount is lesser than tax paid. So you need to create deferred tax, additional deferred tax liability we need to create. If you have to create additional deferred tax liability, the entry will be subsidiary ka retained earnings to deferred tax liability. So retained earnings will reduce. So since the 6,000 will be minus. So you can show this to separately if you're not comfortable. I really personally feel netting off and showing is much better because that's the way we showed it here also. Same fashion way we can do it here also. All right. So after doing all this adjustment, you will get subsidiary ka post acquisition profit after all the consolidation adjustment, which is 2,52,000. What do you will do? Subsidiary ka post acquisition profit you will split among the parent and the NCA in what ratio? 80-20 ratio. So 252 you split in 80-20 ratio, you will get that particular amount. Okay, sir. This is about subsidiary company ka retained earnings. Is that the only thing they have? No, they have some other components of equity also. We studied that. In fact, we wrote the breakup also. Subsidiary company has other components of equity. Where it went? Here they had some other components of equity, 25 million. This 25 million was already existing. We wrote it also here. 25 is pre and 25 is post. So post acquisition other components of equity of subsidiary company is 25,000. There is no adjustment. So directly split between parent and NCI in 80-20 ratio. 25 and 80-20 ratio will be 20,000 and 5,000 respectively. So this is your working note number 5 for analysis of post acquisition profit of subsidiary company. Once this is ready, you can go ahead and prepare NCI on the date of control, right? So NCI on the date of control, meaning you can get the NCI for the consolidation balance sheet purpose, meaning we will get NCI on the date of reporting. That is 31st March 20x4. How do we do that working note? Start with NCI on the date of control. We already have that. NCI on the date of control is 2,98,200. Start with that. Then NCI will ask for their share of post acquisition profit in two components, retained earnings and other components of equity. NCI share of retained earnings is 5,400 and other components of equity share is 5,000. So 5,400 and 5,000 you add. So what about goodwill impairment loss? Since NCI is valued under PSNA basis, NCI will not share or will not bear any impairment loss on goodwill. Here in this problem, impairment loss is there on goodwill. We have not read that adjustment. But bindas, I can go ahead and close off NCI working note because NCI is valued under PSNA basis over here. So impairment loss on goodwill, I'll directly write it as nil. NCI share of impairment loss on goodwill is 0. So NCI for the balance sheet, consolidation balance sheet purpose on 31st March 20x4 is 3,53,600 at working note. Okay, sir. Now, last working note is other equity. But before we do that, they have given two paragraphs. In fact, if you just check, we have not even read that, right? So we'll read that and then if required, maybe 1 or 2 extra working notes we may have to calculate. Then prepare the other equity working note. So let's go ahead and do that. So till here, we have covered the problem. So now this one particular para. Impairment review of goodwill on the date of acquisition they have done. No impairment of goodwill on the acquisition of Vinayak was evident on 31st March 20x2, the first year you got control, and on 31st March 20x3. So because 3 years is already over now. So first year, second year, they are saying goodwill that you got it on the date of control is not impaired. Now in the current year, that is 31st March 20x4, directors of issuer carried out further review because we know we have already studied in IND AS 38 also. The goodwill that you get it as per IND AS 103 business combination, it is not amortized. It is only tested for impairment annually. At least annually, you need to test the impairment on such goodwill. So again, current year, third year we did. So they have done this fair value exercise and concluded that the recoverable amount of net assets of Vinayak is 2,000. So we find out recoverable amount only if impairment indicator is there, right? Anyway, for goodwill we have to find because goodwill does not generate independent cash flows. So goodwill ka impairment check as per IND AS 38, you have to always do it, or IND AS 36 rather, you have to always do it at a CGU basis. So you have found out the recoverable amount of CGU 2,000 million. Vinayak Limited is regarded as a single cash generating unit, meaning the whole company is considered as one cash generating unit for goodwill impairment purpose. So this recoverable amount is relating to the whole company because they're saying whole company is one CGU. So this is the whole recoverable amount of the company itself. If you sell the whole company itself, they're saying it can fetch about 2,000 million. All this you have to express again in thousands because other data is in thousands. Okay, sir. Keep this in mind that this is a recoverable amount for the whole company, which is 100%. Why am I stressing on that? We have done such adjustment in IND AS 36, if you remember. Notional goodwill. We had done some 3-4 questions. It's available on the marathon video also, which I had recorded and explained you. That particular adjustment, they synced up with IND AS 110. That's the reason, now the final syllabus, in fact, I'll tell you a small thing, the story was that whenever we used to write, I cleared my CA exams in 12 years back. Okay. So when we wrote our CA final examinations and all, like, consolidation, amalgamation, okay, and back then it was called amalgamation. Now we study at business combination, right? So those were big ticket topics. People used to say, be very clear on consolidation, be very clear on amalgamation, and two other topics were there. If you're clear with those, at least 40 marks to pakka you'll get. 40 to 50 marks aram se you'll get. And few more standards if you do, aram se you can pass up the examination. That's how most of us used to prepare also. But these days, why am I bringing that particular point is, now consolidation is just not one topic. Okay, in consolidation, you can bring in business combination ka adjustments. Obviously, for consolidation, you need business combination ka adjustments, but some niche adjustments related to business combination can be brought forward here. So here, if you just check over here, IND AS 36 ka impairment of goodwill ka notional goodwill accounting, which we have done, has been brought in over here. And now you will see that IND AS 16 ka provision for DSR has been added up here. Like this, many standards can be collated and made a question. So now if you take a chance that I will skip that topic entirely, if you skip one topic entirely, it has a repulsive effect on the other topic. So the point I'm trying to make is be aware of all the topics. So don't take a chance in by saying this one, I'll skip that, I'll do this and I'll do that and all. Okay. You are at student phase. Now, I know many faculties endorse that you studied this, you only go through this questions and all that. But people look at the approach now. Now the approach has more become MCQ question. They are testing some good questions, right? So if you are clear conceptually, then only you will be able to tackle such questions now. Okay. Gone are those days, because the Inter, they made it very, now it's only 6 papers now. So that means whatever the institute has to test, they have to test in these 6 papers only, and that one though in that is open book examination. So you know what can happen in that, yes. So just be a little careful. So don't be of that mentality that I'll skip this, I'll not do that, what will happen and all that. You're in student phase, so respect the examination. The course is very dignified. It's one of the reputed courses of the country. So don't go for the shortcut methods that I'll only do this, I'll do that and all that stuff. Okay, that will not work, people. You've done your articleship now. You think, can you tell the client, I'll only do half a work, give me full fees? Can you do that? Can you say, I'll only do 40% of audit, or this or due diligence audit? Give me full fees. Will it work? No. So when you're in student phase, okay, do the necessary process. Don't believe in that cutting short of the process. Okay. So if you desperately don't have time now, if you are in the last moment of examination and doing some cut short, that is okay. All right. But if you have some time, if you're watching this video a lot before, all right, then I would suggest stick to the things that needs to be done. Don't go for that shortcut method. It may work for 1 or 2 attempts. Many people are doing that in the market. I know that. Okay. But I personally don't endorse that. I'm not putting the other persons down. Okay. It's fine. Sometimes it works, but sometimes it doesn't. So why take a chance in that, right? So if you properly prepare, then everything is in your hands. That's how I prepared for my examination. And that's the principle I advocate. Rest is up to you. Now, going back to this particular question, they've given the recoverable amount of the whole company. All right. So now the point we have to keep that in mind is, so how do you get basically the impairment loss? Carrying amount we need to compare with recoverable amount. Here they gave recoverable amount for the whole company. That means we want what? We want carrying amount of what? We can't take carrying amount of one assets. Here the whole company is one CGU. That means we want the carrying amount of net assets of the whole company. The carrying amount of net assets of the whole company we need to take. We need to calculate. They have not given, and compare that with the recoverable amount, which is given to be 2000. Then find out whether we have any impairment loss. That exercise we need to do. Okay, na sir. That means we need to put up one working note for impairment loss on goodwill. So how do we find out carrying amount of net assets of the whole company? That so if you want to find out net assets, you are doing this impairment check on 31st March 20x4, no? So we want net assets on 31st March 20x4. But hang on the date of control, do you already know net assets? Yes, we already calculated that. Where is that? Net assets on the date of control is 14,91,000. Okay. So how do you find out net assets? How did you find this 14,91,000 net assets? You simply took share capital, you added profits, yes or no? Equity and other equity you added, and you got net assets. Now, same drama. So up to 31st April 20x1, net assets is this much. There afterwards, what can come? In this 14,90,000, equity is already included. Only one more thing for 3 years is not included, because we have got net assets on 1st April 20x1. We want it on 31st March 20x4. From here to here, if you count, it is 3 years. So what? We have to just add other equity for 3 more years. That's all. If you do that, you will get net assets for the current year. Okay, sir. So what is our other equity? We have 2 components in other equity, retained earnings and the other components of equity. And that we already know. So that only we call it as post-acquisition. Now, post-acquisition means after acquisition. So post-acquisition profit after all adjustments for consolidation purpose of retained earnings is 252. For 3 years, post-acquisition profit of subsidiary company is 252, retained earnings. And post-acquisition other components of equity is 25,000. So 2,52,000 and 25,000 is post-acquisition retained earnings and other equity. Add that. This is the net assets. These two you add, which you already have it from working note. So just add that. That's all, sir. No. So we want net assets of the whole company, right? Net assets means it will include every asset. So what, sir? One asset is not included in these two numbers, which is what? Goodwill, right? In this 14,91,000 is goodwill is included? No. In this goodwill is included? No. So now you need to consider goodwill. Sir, goodwill we already calculated. No, sir. Yes, the goodwill value is how much? 2,07,200. I've also put a tick here, right? So this is the goodwill on the day you got the control. 207,200. Can you record that? No. Why? Sir, this goodwill is partial goodwill because NCA is valued under PSNA basis. The goodwill that you get is, we call it as partial goodwill. Partial goodwill means parent's share of goodwill. And what is parent's share? 80%. So this is the goodwill relating only to the parent, and once only parent will bear the impairment loss. But they gave recoverable amount for the whole company. Whole company is 80%. No, it is 100%. So can we take 2,07,200 for impairment loss calculation? No, we have to calculate full goodwill. There are two approaches. First, you can take the goodwill of 2,07,200. Then you can add a notional goodwill. That's the way I've shown it in the IND AS 36. But here, since the problem is already lengthy, I've cut short the one particular step I've cut short. 2,07,200, sir, is a goodwill for 80%. For 100%, how much? Prorated. 2,07,200 is a goodwill for 80%. For 100%, how much? So 207,200 into 100 divided by 80, if you do, you will get 2,59,000. So basically, the difference between 207,200 and 259 is nothing but notional goodwill is what we used to refer in IND AS 36 problems that I've already included and that you have got. Okay, sir. Now all assets have been included. Yes. Now you'll get the net assets. This recoverable amount they only given in the question 2,000 million, which I have expressed in full value. I mean thousands. There is this much. So carrying amount is this much. Recoverable amount is that much. So do you have impairment loss? Yes. We have 27,000 as impairment loss. So can we record this? No. Sir, you could have accounted. This is the 27,000 is the impairment loss, including notional goodwill. Have you recorded 2,59,000 as goodwill? No, you have recorded only 207,200. That means full impairment loss on goodwill can you record? No, here also you need to prorate. This is how we used to do IND AS 36 question. In fact, this one you can do it straightforward way, but I always used to suggest you the proration method because it works for other questions which I've showed you, right? So you can record impairment loss of 27,000 provided you have recorded full goodwill in your books for 259. If you have recorded goodwill at 259, full impairment loss of 27,000 you can book, because we know this. Whenever you get an impairment loss, first we'll adjust it with goodwill, then to the balance to the other assets in their carrying amount ratio, right? So hence goodwill amount here only is more, means entire impairment loss will be adjusted with goodwill only, correct? But the problem here is you can record impairment loss of 27,000 provided you have recorded full goodwill of 259. Have you recognized full goodwill of 259? No. On the date of control, you have recognized goodwill only to the extent of 207,200. So if this is 207,200 means how much is impairment loss? Like that you need to prorate. Or simply you can take, since you have recognized only 80% of goodwill, only 80% of impairment loss you can recognize. That's what I've written here. But to be on the safer side, there is one more way in this adjustment can be asked. You can refer IND AS 36. Okay. So this particular proration method will work for under every circumstance. Hence I always suggest this proration method than this direct method. So the impairment loss on goodwill you recognize is 21,600. And this impairment loss only parent will bear because we have got NCA is valued under PSNA basis. So hence NCA share of impairment loss of goodwill is nil because NCA is valued under PSNA basis. Now we got impairment loss on goodwill. Yes, 21,600. Come back to goodwill working. On the date of control, it is 207,200. Impairment loss we just now got is 21,600. You minus this. Then you will get what is the goodwill to be shown in balance sheet, which is 185,600. This is your done. Okay, Saru. So this working note number 4 and 7 is done. So I mean now we can prepare other equity working note, sir. Hang on. One more paragraph is there which we have not read. So goodwill ka we have done. So this is again a star adjustment. So the goodwill wala. Okay, this particular component. Okay. So where this the impairment loss, that is a boxed item. In fact, this whole working note 7, you can put it as a boxed item. So this is a good adjustment from this particular question. We have done such question, but we have done it in IND AS 36. But that they have combined it with IND AS 10. That makes this IND AS 110. That is making this particular question a lot more interesting. Just 1 second. Yeah, okay, moving along. So next one more para is there. Let's read that. Some provision. On 1st April 20x3, we got the control on 1st April 20x1. 2 years later, meaning in the third year beginning, Ishwar Limited, the subsidiary company, or no, Ishwar is a parent. Okay, parent completed the construction of non-current asset. So Ishwar is a parent, not subsidiary. Keep this in mind. They completed construction of a non-current asset with an estimated useful life of 20 years. Great. The cost of construction were recognized in PPA. So cost and all, construction cost. So it is a DAC. Can you add it? Yes, they've added. So depreciation is also done properly. That there is no mistake. Ishwar Limited, the parent company, has a legal obligation to restore the site. So that means here we have a legal obligation to restore the site. So this is your DSR. So we have to make provision for DSR, right? But this DSR or not will not come now. It will come at the end of asset ka useful life, which is after 20 years. But so what is IND AS 16? We have done such question. We have to recognize provision for DSR at the present value, correct or no? So check what have they done. They have a legal obligation to restore the site on which non-current asset is located on 31st March 2043, some 20 years later. The estimated cost of restoration cost on 31st March 2043 after 20 years, it is 125 million. That is the restoration cost. So we need to make provision for DSR. Yeah. But what did the company do? The directors of Ishwar, the parent company, have made a provision for 6.25 million. Are you crazy people? They made a provision. All right, for 6.25 million. How did they get the 6.25 million? They took 125 million, and this is you have to make this provision after 20 years. No? So they divided this by 20. 125 million divided by 20. If you do, you'll get 6.25 million. Can you do this? No, this is not the way to do it, right? You have to take the discount factor and recognize provision for DSR at present value and do unwinding of interest. That ACM table we need to put up, correct? That means finance charges and all will come, sir. Yes, sir. They have not recognized. And when the standard says they made a provision, it means normal provision. For normal provision, what is a journal entry? SPL account debit to provision. So they have made an entry for provision for 6.25 million. What the question is trying to say, when they say provision, they just mean they have not capitalized this expenditure. They have made a provision using SPL. So parent company, they have utilized their retained earnings, their SPL. This is relating to only parent. Keep this in mind. This is not subsidiary. And subsidiary, all the working notes we have already done. This affects only parent's retained earnings. So SPL account of the parent they have debited to provision they have made for 6.25 million. This is what they have made. Okay. Is this correct? No, it is wrong. So what we have to do? Whatever they have made, we need to reverse. Okay. We have to reverse because we will not transfer this provision to SPL. We will have to capitalize. So I mean, with the entry I've shown in the working note, but just saying. So this treatment what they have given is wrong. Alright. Appropriate annual discount rate is 6%. So discount factor is 6%. And the present value of 1 and 20 years is 31.2 paisa. 31.2 paisa is nothing but 0.312. So at 6% for 20 years, the discount factor is given to be 0.312. Okay, sir. So let's prepare one working note for provision for DSR, which I've done it over here. Because it affects other equity working note. That's the reason. So first, how much is provision for DSR required to be capitalized, not P&L. Requires to be capitalized to PPA. How much is that? 125 million is a cost. So 125 million, if you have to express in 1000, so add 3 zeros, it will become 1,25,000. That is the cost you will get it after 20 years. What is the discount factor? At 6%, the discount factor is going to be 0.312. Calculate that, you will get present value. So for this 39,000, we need to pass the entry now. Now means current year beginning. What? Will you write SPL account debit to provision for DSR? No. You write PPE account debit to provision for DSR 39,000. That is one. That means this particular adjustment impacts PPE also. Keep this in mind. Alright, that is one. Then what did they do? They passed the journal entry SPL account debit to provision. So is that acceptable? No, you need to reverse that. Right? They made the general provision which we need to reverse. Correct? So the entry for that will be provision account debit to SPL 6250 because they have made 6250 with provision. Here that's what we wrote. 6.25 million. If you have to express that in 1000, multiply 3 zeros. 6.25 into 3 zeros, if you multiply, you'll get 6250. Okay. So provision, general provision made through SPL to be reversed. That is one. By passing this entry, I've shown it corresponding. Okay, Saru. That's all. No. Sir, you have shown the provision for DSR at present value. Correct. But you will not settle it at 39,000. You will settle it at 1,25,000. So that means as the time passes from 39,000, provision balance should become, it should increase and it should become 1,25,000 after 20 years. That means you need to put up ACM table. But since we are doing the accounting only for, all this data is coming on 1st April 20x3. And we are preparing consolidation balance sheet on 31st March 20x4. That means we need finance charges only for 1 year. No? Don't do it for 3 years. Because fair value adjustments and all, you did it on the date of control. This particular DSR, they clearly told it's coming on 1st April 20x3. In fact, I've written that also somewhere. Just saying, the finance charges should only come for current year, not for all 3 years. Because you've been used to doing that additional depreciation for 3 years. Here also don't do it for 3 years. Okay, so we need finance charges only for 1 year in this particular problem. Okay, Saru. Alright, that is one. Now for 1 year, we need to prepare one ACM table. Not required, right? So we can directly do it. What it will be? Visualize. The opening balance of provision for DSR is 39,000. Then we book finance charges at what rate? 6%. So 39,000 ka 6% you do. It will be 2340. Then payment. Payment is not done now. Payment is done only after 20 years. So payment column is 0. ACM table I'm asking you to visualize. So we write opening balance, we write finance charges, we write payment, and then we write closing balance, right? Opening balance and finance charges we add, payment we reduce, then we'll get the closing balance, right? So again, so adding these two, okay, you will get the provision ka closing balance. That provision ka closing balance, you all have to show it in your in your consolidated balance sheet. Okay, that is one. All right. So for finance charges, what will be the journal entry? Finance charges account debit to provision for DSR 2340. That is one. And this finance charges will be transferred off to SPL or retained earnings, of which parent. All the adjustments relating to parent. Subsidiary drama is already over now. Okay, Zaru. But what mistake our accountant of parent company did is they made a general provision. They did not capitalize PP. This particular provision for DSR should have been capitalized, but they did not do. That means the depreciation they've charged on PP, is it correct? No. This 39,000 they did not capitalize means the value of PP is shown as wrong. So since PP balance due to the adjustment is increasing, we will get additional depreciation. This additional depreciation is not due to fair value adjustment. It is due to provision for DSR. So you will get some additional depreciation due to this provision for DSR. How much? 39,000. Okay. 39,000 is depreciation. No, 39,000 is the value by which PP balance will increase. Minus what? Residual value 0 divided by life, which is 20 years. Okay. So additional depreciation you will get it is 1950. And depreciation ka entry will be depreciation account debit to a PPE account. So this depreciation will be transferred to parent ka SPL or retained earnings. Yes, no? SPL, but here we're not preparing P&L account. That's the reason I'm using the word retained earnings and SPL interchangeably over here. Okay, sir. So, but it will go off to SPL only. But since we're not preparing SPL, we'll do all the adjustment in retained earnings itself. Yes, sir. That means due to this adjustment, okay, you will get 3 components. One, you have to reverse provision. Okay, then you have to charge finance charges, then additional depreciation. 3 extra working notes which will affect retained earnings of parent comes from this particular working note. So once you are ready with this, then you can prepare finally other equity ka working note. Okay, now we have 2 components of other equity, retained earnings and other components of equity. Now subsidiary ka retained earnings and other equity will come? No, it's already distributed. So take only parent. What is a parent company ka? Come back to balance sheet. Parent ka retained earnings is 28,65,000. The issuer is parent, and other components of equity is 12,50,000. So copy that number. Okay, this is given. Then post acquisition profit of subsidiary company, we have some working note here. No, post acquisition issuer ka share is 201 here and 20,000 here. So 201,600 and 20,000 add, because post acquisition profit of subsidiary this is correct, sir. Then do we have any impairment loss on goodwill? Yeah, we calculated in the above working note 21,600. Entirely parent will bear because NCA is valued under PSNA basis. Okay, so then what's the you remember first point when we read, I said don't forget one adjustment. There was some transaction cost here, this adjustment. There was some transaction cost of 15 million. What did the parent company do? They added it to the cost of investment. But Ind AS 103 says transaction cost to be transferred to SPL. So that means they have added this to the value of investment. So due to this adjustment, investment balance you need to reduce because they have added to the cost of investment. So the entry you need to pass is SPL. Since we're not preparing P&L here, you write retained earnings to what? Investment in subsidiary company. Correct. How much? 15,000 because it is 15 million. So this entry we need to pass. So if you are debiting retained earnings, obviously its balance will reduce because this expenditure transaction cost, no, they added it to the cost of investment. But as per Ind AS 103, this transaction cost is an expense, has to be transferred to SPL, which they have not done. So reduce that first. So this is done, this is done, this is done. Okay, sir. Then 3 adjustment which we got it from the provision for DSR working. One, whatever provision they made, which is 6250, we need to reverse. When you make provision, balance, retained earnings balance will reduce. Here you are reversing. So 6250 you will add. That is one. Then next is finance charges. How much finance charges? 2340. How much is the additional depreciation? 1940. Both are expense. Due to this, retained earnings balance will reduce. So 2340 and 1950 you reduce. Then you will get the correct balance of retained earnings and other equity. If you add up, you will get it. So adding these two will become your total other equity for consolidated balance sheet. Okay, sir. So you just check, these are all adjustment they've asked. Such a big question, it will come, sir. We never do, sir. Okay, because if they give such question, they'll make the other questions little easy and less lengthy. Okay, so if all other questions are little less lengthy or pretty easier, then they can make these sort of questions little lengthy to cover. So they will somehow match, but you can expect the papers to be on the lengthier side. I always tell this in my class. Go ahead with the expectation that 3.5 hours ka paper you need to attempt within 3 hours. If you go with that expectation, you will not get hurt later on, because this is the common comments we hear from many students. I knew everything, but paper was lengthy. Paper is lengthy. That is there from this your CA intermediate days. You know that. It's not a new thing to us. Okay. So simply go ahead with the expectation. Such questions can arise. You never know. All right. It has come, meaning it's there, means it can come in your paper. You never know. Okay. So that is one, sir. Now consolidated balance sheet. This much if you have done means consolidated balance sheet is very, very straightforward, sir. What it is it? Simply take what? I'll just bring this number a little closer. Okay. So I'll quickly show you. Okay. This is straightforward addition. Where is it? Here, maybe I'll bring it up. Okay. Now, what do you do, sir? Parent and subsidiary company ka assets line by line you add. So 26,20,000 plus 18,50,000. I've written the breakup also here. So these two. Yes, no, sir. Then, did you do some fair value adjustment? You got it from working note number 1, which is 3 lakh. Then, did you get additional depreciation? Yes. On building, you got 15. On plant and machinery, you got 75. We captured that. All this is there. I hope you remember that. Then, provision for DSR. Did they record properly? No. It had to be capitalized. They did not. They transfer it to SPL. So this is your provision for DSR to be capitalized. And because of this capitalization, you will get some additional depreciation of 1950. This came from your working note number 7. Okay. So these numbers are there in your working note number 1. In fact, all these numbers are there in your working note number 1. This is there in your working note number 7. Simply due to that impact, you need to tell whether PP increased or decreased. That's all. Okay, sir. That's all. If you add all this, you will get 1417,050. I've given the breakup. Okay, G. And investment. Investment, what is the balance of investment? They've given 21,15,000. So take that. Sir, investment will not come, no, sir. Sir, investment in subsidiary company will not come in consolidated balance sheet, but you may have other investment. So always check. 21,50,000 is a total investment. In this, how much PC you gave? How much PC you gave to buy subsidiary company ka shares? Totally you gave 14 lakh PC. So reduce that because that is investment in subsidiary. It will not come. Then, sir, transaction cost. If you remember 15,000 ka transaction cost, they added to cost of investment. But this should not be added for consolidation purpose. You should not add it to the cost of investment, but transfer it to SPL. Right now they have added, so reduce that. Okay, so that is one adjustment. So you will get that. Goodwill you will get from working note, assets and balance sheet over. In fact, current assets. Sorry, my bad. Current assets, trade, cash, inventory, receivable, cash, line by line addition. Because there is no adjustment. Straight away take the value from question and add it up. Balance sheet, asset side over. Liability, share capital of only the parent company will come. Right? The retained earnings and other components of equity, we will get it from working note number 8. If you just check our working note, 31,960, 12,70,000. What did we get, pa? 1 minute, it's loading. Here, 31,960 and 12,70,000. Okay, same value, they have also called out over here. Yes, sir, people. Then non-controlling interest also, we'll get it from working note number, same number. Okay, then provision. Provision may check. What provision is given in the question? Provision as per the question is 6250 and 0. Take that first. 6250 and 0 is what is given. Sir, they have made provision for DSR. They made a general provision. Is that acceptable? No, we need to reverse. So minus 6250 you. Because they have made a general provision. This provision should not be transferred to SPL. It should be capitalized. So whatever they made, we reduced it. And they did not make provision at the right amount. We have to make the provision at present value. They just took some random amount. They took the total amount divided by 20 years they did. It is not acceptable. Hence reverse that. Then, should we make provision for DSR? Yes. As per working note number 7 or 8, we got provision to be 39,000. That's all. No. This is the provision and on 1st April 20X3, third year beginning. Yes, that is the present value. As year pass, finance charges will come. The entry for finance charges is finance charges account debit to provision for DSR. So yes, instead of putting up ACM table directly, I'm doing over here. This is your finance charges. So this will be, these two are nothing but your closing balance of provision for DSR. If you put up ACM table for 1 year, you will get the same answer. So these two addition, because whatever provision you have made, you have reversed. So this is your provision ka present value. This is your finance charges. Adding, you will get 41,340. Okay. Long-term borrowings, the line by line addition. That's it. Okay. Then deferred tax. The deferred tax is coming on the liability side. So it is deferred tax liability. What is given in the question? 2,25,000 and 140. So add that. This is given in the question. That's fine. Then, did we create any additional deferred tax liability? I think we did. Check our working note. We did some creation also. We did some reversal also. So DTL, we created 54,000. It is there in working note number 2. And we reversed 12,000. So 54,000 DTL will be added. This 12,000 is a reversal. So 54 and plus 54 minus 12. Done. Check. Plus 54,000 minus 12. This is DTL creation due to fair value adjustment. This is the DTL reversal, which is again due to adjustment. So net DTL will be 407. Then it's your current liability, which is given in the question. Okay, that is just line by line addition. There is no adjustment there. So these two are value given in the balance sheet. Add off. You will get it. So with this, particular question, we have done it. Okay, sir. So hope this session was helpful to you. Thank you.